Welcome to the Compliance 911 Show, a no-nonsense podcast discussing hot topics for today's busy compliance professional. It's everything you wanted to know about regulatory compliance, but we're afraid to ask. And now, here are your hosts, Dean Stockford of M&M Consulting and Len Suzio of GeoData Vision.
So what interesting topic did you bring for discussion today?
Well, you and I are recording this podcast on August 5th, 5 days after the OCC and the FDIC published a notice of proposed rulemaking on revisions to the Community Reinvestment Act rule. So that is the hot topic for the next few months. And I thought it would be interesting to give listeners an overview of the key changes proposed in the NPR.
Well, that sounds like a timely topic, and I'm sure our listeners will certainly be waiting with bated breath. Where do we want to start, Len?
Well, the headline grabbers are, first, that the Fed has not joined with the FDIC and the OCC in proposing this rule, and second, the change in bank size categories, which has dramatic implications for who reports activity under the Community Reinvestment Act.
It always frustrates me when you can't get the prudential regulators to come together on this type of stuff because it just adds to the confusion. So do you have any insight into why the Fed has not joined the OCC and the FDIC?
Well, the Fed hasn't made any statements on why it has not joined its sister regulators supporting the NPR. That's a sign to me that the Fed does not necessarily object to the proposed rule. I think the Fed's been waiting for Jerome Powell's replacement as chairman of the Fed. With the appointment and approval of Kevin Warsh as the new chair of the Fed, I believe that the stage has been set for the Fed to join the FDIC and the OCC in support of the NPR. We do know for sure that the Fed supported the rescission of the 2023 CRA rule and joined with its sister regulators, the FDIC and the OCC, regarding that. And so that's an indication to me that they believe change is necessary. And I predict that the Fed will join the proposal sometime before the end of August. It's difficult to imagine a CRA rule for Fed-regulated banks different from that of the FDIC and the OCC-regulated institutions. But of course, there is a precedent for a separate CRA rule that was established by the OCC in 2020. But the 2020 OCC approved rule, was rescinded less than a year after it was approved.
Yeah, and I think many are saying, phew, thank God it was. But okay, so what about the new bank size groupings in this new proposed?
Well, the NPR maintains three separate groupings of banks. Small banks, which will be banks with less than $1 billion in assets, and that compares to a cap of $402 million in the current rule. Intermediate banks, and by the way, they're going to be called intermediate banks, not intermediate small banks, as they are in the current rule. And they will have assets of $1 billion or more, up to including $10 billion. And that compares to the current cap of $1.609 billion currently. And then large banks with assets greater than $10 billion. While the media focus has been on the $10 billion threshold, the NPR does call for a possible threshold of $3.252 billion, and no one has said much about that. And that, of course, is quite a difference. And I want to ad lib and just say one other thing about this, Dean.
Yeah.
The media has been misreporting some major elements in this. The AP ran a story on Friday, the day the NPR was proposed, in which they said it was going to dramatically cut the number of lenders that were subject to the Community Reinvestment Act. And that is completely factually wrong. The NPR does not affect not even one institution that's covered by the rule. It does dramatically reduce the number of institutions that report under the rule, but all FDIC insured banks must comply with the rule. There will not be a change of even one institution.
Yeah, well, we all know that these, asset size thresholds carry different provisions based on, what category or what box you actually fell into. So what are the implications of the new size standards, and do they have any significant impact on these regulated banks?
Well, I'm certainly glad you asked that, because the implications are very big. As currently the practice, only banks classified as large banks will be mandatory reporters under the CRA rule. For the latest year for which CRA data has been reported, 731 banks reported their activity under CRA. That includes the banks regulated by all three agencies. With the $10 billion threshold, the agencies indicate that only 86 institutions regulated by the FDIC and the OCC will be large banks under the new rule. If the Fed were to join the NPR, that would be another 49 banks of more than $10 billion in assets. Combined, we'd be looking at 135 institutions that would report compared to 731 institutions that reported activity in the latest data, which was for 2024.
So I'm wondering if maybe the headlines, they're a little confused as to what they're talking about. So there would be a very substantial reduction in reported lenders, right?
Yes, and I believe, unfortunately, that's the worst, most negative thing in the NPR. This means, except for the very largest banks, there won't be any peer lenders for anybody. This already has been a weakness in the legacy CRA rule. It'll be an even bigger weakness in the new CRA rule if the NPR is approved as proposed. The irony is that the HMDA data, which has no such glaring gap in reported lending, using that data, it's possible to conduct an analysis based on peer comparisons for any bank. But that won't be true for small business and small farm loans if the $10 billion threshold is adopted. Now, a lot of bankers like this, quote, regulatory relief, end quote, but I believe it hurts banks far more than benefits them. I mean, after all, what community bank wants to be compared to benchmarks established only by the mega institutions? If you are a bank subject to CRA, prudence would dictate that you should be collecting and monitoring your compliance risk. And if you are collecting the data to manage your compliance risk, why would you not report the data? Not only that, Dean, but if you are a community bank, chances are that your small business and or small farm lending is probably no more than 100 originations annually. The FIEC offers free, that's zero cost CRA software. So the cost of capturing CRA activity and recording it should be very, very minimal. Now, no responsible banker should consider relief from reporting their CRA activity as true relief, because every bank will still be required to perform under CRA, but you won't know how well you are performing without capturing the data. To me, this is relief in name only. It's a way the regulators hope to get support from the banking industry. But if there's no real relief from performing under CRA, relief from reporting is not meaningful. In fact, I would characterize it as dishonest.
Okay, so we've covered two, I will call, really big issues in the NPR. What other surprises have you been able to unpack in that NPR?
Well, there are several changes proposed for assessment area delineation. I've always considered assessment area delineation as the most important CRA decision a bank can make. So any changes to the rules can have profound implications for banks. The NPR proposes two changes regarding assessment area configuration. First, it proposes not allowing any assessment area overlap of an MSA boundary. Second, it proposes that large banks must include whole counties within their defined communities. Now, regarding the MSA overlap, a prohibition against annexing any tracts on the other side of an MSA border can create an unrealistic boundary when a bank has a branch in a tract immediately next to a MSA boundary. That branch could generate lending on the other side of the boundary that would be considered as lending outside the bank's assessment area. And that means those loans won't be considered in the CRA exam. And by the way, the new rule would prohibit consideration of any loans outside the assessment area. That's another big consequence if the NPR is adopted as proposed. Now, regarding the entire county requirement, even the largest banks not be able to serve an entire county. For example, Los Angeles County has just under 2,500 census tracts. A large bank with only one or two branches can't possibly serve the entire county. The NPR recognizes this and explains that this could be considered as a, quote, performance context factor, end quote, that would mitigate the negative implications of the unrealistically defined community. But who wants to start out with unrealistic assessment areas and count on the goodwill of the examiner in charge to understand that's why the bank doesn't look good with the standard calculations? it's certainly not a good start by putting the bank immediately on the defensive in a CRA exam.
That's for sure. No doubt about that. They definitely do not want to be reactive to the EIC. That's for
Hmm.
sure. So we've covered obviously the institutional sizes, reporting mandates, assessment area configuration, and I think I know what's around the corner because it's always a big one. But what else would you like to add to our, for our listeners?
Oh, yeah, there's plenty more to go
Yeah.
that we won't be able to cover in today's session, but I'd like to review the community development considerations. But those are so many and so significant, I will leave them to our next podcast. So, listeners, make certain that you listen to the follow up podcast to this. But I would like to mention a few things about the performance test. First, the proposed rule will consider only lending activity and not any depository requirements or services. The regulators feel that it's consistent with the statutory mandate to meet the community need for credit services. So when it comes to the service test, deposits won't be considered, only credit services. Second, banks that are not large banks will no longer be evaluated based on response to written complaints. That's interesting because
Mm.
up until now, if a bank hasn't responded to written complaints or does not give an adequate response, that can affect your CRA performance rating. Well, that will no longer be considered for banks except for the so-called large banks. The third thing I'd like to talk about briefly is regarding the credit products the NPR adopts, which the NPR adopts the concept of a major product line and proposes that only two major product lines will be evaluated in a CRA exam. Consumer loans will be considered as major product lines if they constitute a majority of a bank's retail lending, both by count and by amount. This also means that banks that actively engage in HMDA, small business, and small farm lending will be evaluated for only two of the largest of those types of loans. The calculation, and by that I mean the largest volume of those loans, the calculation would be based on counts and dollar values over the exam period and would be determined at the institution level. Although there is a section in the NPR which does provide an option to consider assessment area issues so that the major product line could change from one assessment area to another. And by the way, it's stated in the NPR that loans that are not major product line loans could be considered as community development loans if they fulfill a community development purpose. So this is another reason to wait for our next podcast to talk about the community development aspects of the NPR. There's also, by the way, a threshold of 30 or more loans to qualify for a what they describe as a quote meaningful end quote analysis.
Certainly a lot to unpack for sure. And I know that there's a heck of a lot more because if my memory serves me right, when we spoke the other day, you were saying there's well over 400 some odd pages of this to unpack. So
Y-
are there any
Yes,
other tidbits? Yeah. Yeah. So any other tidbits, Len, that you want to add before we end today? And
sure. The intermediate banks, which will replace the intermediate small banks, will not need to pass the community development test to get a composite satisfactory performance rating as long as they attain at least a satisfactory performance rating on the lending test. That's been one of the problematic parts of being an intermediate small bank to the current regulation, because under that regulation, or that rule, I should say, you had to pass both the lending test and the community development test. It didn't matter how well you performed under the lending test. If you didn't pass the community development test, you would fail your CRA exam and in terms of a composite rating. So that's a very big improvement as far as the intermediate banks are concerned. And it's something that any of our listeners today who come for banks that would be in the $1.6 billion size range or more will find very appealing.
yeah,
And by the way, I should mention too, by the way, since ISBs, intermediate small banks, are really start at 402 million up to 1.6 billion right now, even banks in that category will find that very, very important and an improvement. And it's the banks up to 1 billion will be relieved from anything regarding community development because they'll be small banks, and the banks of 1 billion or more will be the intermediate banks up to the $10 billion limit. So those are the
Hmm.
institutions listening to today's podcast
Wow.
that will benefit a lot from this change.
Yeah, I know that's an area that's always been a pain point for institutions, especially the intermediate banks. But in any case, you certainly covered quite a bit today, and I'll say I can't wait and until you cover the community development implications in our next podcast, because I'm sure that we'll probably blow the charts with the listeners for that one, because that will be a real big one.
Yes. And Dean, I want to make a point of encouraging our bank listeners to submit their comments about the NPR to the regulators during the comment period, which actually, as of August 5th, hasn't commenced yet. It starts when it's published in the Federal Register, which probably will be in the next couple of days. But if bankers don't speak, then regulators will hear only from activists who think that the CRA is not tough enough. So as the saying goes, speak now or forever hold your peace.
Yeah. Well, no, that's great advice. And, we often see bankers are asking, how do we get involved? How do we do this? Well, this is this is the way that you can influence perhaps the outcome of the final rule. But in any case, thanks, Len. Absolutely a tremendous presentation. Very timely given when it came out, the NPR, and again, great information and encouraging folks to get involved and issue their comments. But so thank you very much. This is Dean Stockford from M&M Consulting.
And this is Len Suzio with Geodata Vision saying, we hope you enjoyed today's podcast and learned something from it. We encourage you to send us your feedback and any ideas you may have for future podcasts.
Thanks for listening to the Compliance 911 Show. If you like the podcast, be sure to subscribe so you don't miss an episode. While you're at it, please give us a like and review to help others find the show. As always, links are in the show notes, and you can always find us online at compliance911show.com. Follow M&M Consulting and Geodata Vision on LinkedIn for all the latest news and information on compliance hot topics.